Well, hello everyone and welcome. Cynthia Tomei here. Oh, hold on a moment. Let me see, we had a little bit of feedback there. Sorry about that. Okay, well, hello everyone. Cynthia Tomei here with Interactive Brokers, and thank you for joining today's webinar that's being brought to us by the Singapore Exchange. We're very pleased to have with us Tariq Dennison, who is a wealth manager and investment advisor with GFM Asset Management. So with that, I'm going to pass the controls over to Tariq. If you could share your desktop, let's get underway. Thanks for joining us today, Tariq. Take it away.
Hi, Cynthia. Is that clear? Sorry, there's a speaker in here that we're not able to mute yet.
Okay. Sorry about that, everyone. I think you've done it, Tariq. That's much better. Oh, much better. Thank you very much.
When in doubt, just pull the plug. Sorry about that. So, okay, thank you. Can you see my screen now, Cynthia?
Yes, your screen, it's full screen, so it looks like we're ready to take it away. Go ahead, Tariq. Thank you.
Excellent. Well, thank you very much for the introduction, Cynthia. So as I mentioned in the promo video on my social media channel, this is one of a three-part webinar series about investing after COVID-19, where if you caught me 2 weeks ago, I was talking about investing in China after COVID-19, specifically using the A50 and Chinese yuan renminbi futures listed in Singapore. And next week, just as a preview, I'll be talking about investing in India after COVID-19. Here I'm talking specifically about Asia's ETF hub, namely Singapore-listed ETFs that should be of interest to foreign institutional investors. So I will talk a little bit later about why I'm focusing on some ETFs more than others. But before I get into it, first I do need to show you some disclaimers. First of all, our disclaimer. And next, a separate disclaimer by the Singapore Exchange. Excellent. So with those disclaimers out of the way, I just want to briefly introduce myself to any of you who may not know me already. My name is Tariq Dennison. I am based in Hong Kong, and I run both a Hong Kong licensed and US licensed investment advisor firm that is one of the advisors on the Interactive Brokers platform. So we can manage Interactive Brokers complete accounts or partitions of Interactive Brokers accounts on the Interactive Brokers platform with our advisor account, and the instructions for how to set up a managed advisor account are on our website. I've been in the market since 1998, and I have experience with a variety of investment banks in New York, London, Frankfurt, Toronto, before coming over to the buy side in 2012. I have a master's in financial engineering from the University of California at Berkeley, and I teach fixed income and alternative assets at ESSEC Business School in Singapore. My main focus, and one thing that I talk about a lot on these webinars, really is the US-Asia corridor. As you can probably tell by my accent and my registrations, I'm American, but I've been living here in Asia for 10 years. Even for 10 years before I've come out here, I was very much focused on Asian markets. And so very much helping Americans invest in Asia, helping those based in Asia invest in the United States, and seeing which of the two markets are competitive with each other. And the one book I've come out with so far is a book titled Invest Outside the Box, Understanding Different Asset Classes and Strategies. There's a picture of the cover right there in case you'd like to look it up. So, goals of this presentation and some assumptions about my audience here. So I want to make sure that we use our time wisely and you're quite clear what we should expect to get out of this 45-minute session before questions and answers. First of all, I want to compare the Singapore Exchange to other ETF exchanges. This webinar is sponsored by Singapore Exchange in addition to Interactive Brokers, but as mentioned in the disclaimer, I am not affiliated with Singapore Exchange. I am just an end user. I have a choice on which products to trade on the SGX versus which to trade on the NYSE versus which to trade on the LSE. So I'm going to be using part of the introduction to provide that comparison. and help you as an international investor decide which of these exchanges you want to trade on in your Interactive Brokers account. Next, I want to outline which of Singapore's ETFs are most internationally competitive. There are some ETFs which I believe are really more for local consumption, while there are others which I believe even non-Singaporeans from outside of Singapore should consider trading on the Singapore exchange because they are either best in class or unavailable anywhere else. Next, we're going to evaluate some of these ETFs specifically the ones that we see foreign institutional investors using. I also, for anyone on this call that might be an ETF product provider, say a fund manager or a market maker or a sponsor, I hopefully also hope to highlight which products I see gaps in the Singapore ETF market, so that if you're looking to launch an ETF in Singapore, these would be some of the ETFs on my wish list, which I wish you would launch because they're not here yet. Now, some assumptions about you. First of all, I am assuming that you do understand ETFs. This presentation is not an ETF 101. I'm assuming that you already understand what an ETF is, how creation redemption works, how ETFs trade, and how you would use ETFs to access or track certain market benchmarks. So I also assume you understand the differences between different forms of asset allocation, geographic asset allocation, smart beta, equities versus fixed income, commodities, for example. And I'm also assuming, given that this is an Interactive Brokers sponsored webinar, that most of you probably have Interactive Brokers accounts. Interactive Brokers, of course, provides really good access to many, many different exchanges at really attractive rates, which is one reason I've been using them for almost 20 years. So I'm assuming that you have the Singapore Exchange enabled in your accounts, and so you could shop for the ETFs there and decide which of these you want to trade. And another key assumption here is I'm assuming you are seeking to trade globally. The key thing I want to highlight and say explicitly is that this presentation really is specifically not for Singaporeans, because I have a different presentation that I make for Singaporeans who are trading ETFs with local brokers. This one really is more specifically targeted to those of us based almost anywhere else who might not have looked specifically at Singapore's ETF market, and I will hope to highlight some of the things that are special about it and why you might want to pay more attention to it. So, some of the outline of the progression of what we're going to talk about here. First of all, fixed income ETFs, specifically what's so special about them given Singapore's currency. What are some of the local liquid trackers, specifically those tracking the Straits Times Index, but also real estate investment trusts, one of the largest markets here. Then we're going to be talking about India, and then other X-trackers. So that's one specific ETF provider providing country-specific trackers on China, Thailand, and Vietnam. Then, as I mentioned, I'll also mention some of the gaps that are on my wish list that I would like to see an ETF provider come in and provide. Now, why do I specifically look at this exchange? Besides the fact that I've been investing in Singapore for a long time and I'm quite interested in this market, why do I look at ETFs that are listed here? Well, first and foremost is time zone. I am based in Hong Kong, and I look at ETFs that are listed on the Hong Kong exchange as well as ETFs listed in Singapore because they trade when I'm at my desk, when I'm at the office. Second reason is taxes. So even though I do manage money for U.S. persons, the ETFs that I trade out here and I look for out here are mostly for accounts of non-U.S. persons. There are many reasons why a non-U.S. person should not want to trade a U.S.-listed ETF, and I'm going to highlight that in a later slide. So a key point there, the key word to watch out for is what's called UCITS passporting, and I'm going to mention that in a later slide. Another reason is currency. For many clients, I've been looking to diversify away from U.S. dollars specifically, and one of the things I'm going to talk about later is the Singapore dollar. How is it managed? What are the prospects for the Singapore dollar as a currency? And why would we want to trade some of our ETFs in Singapore dollars? Now, naturally, if you want to invest in Singapore, there's really no better place to do it than to trade it in Singapore. I would say that's kind of natural or somewhat obvious, but that's not just your classic Singapore stocks or Straits Times Index. It's also the real estate investment trust market, which is about 4 times larger than Hong Kong. Another thing that I also quite like about the Singapore Exchange specifically is CDP. That is the central depository, basically where your shares can be held in safe custody in a centralized location. That is something that I haven't seen quite as commonly used in the US or other markets, but basically just about anyone in Singapore who opens a brokerage account will then open up a CDP account, which provides for excellent safekeeping. Again, that may not necessarily be relevant to those of us who trade SGX listed shares on our Interactive Brokers accounts, but it's something to keep in mind as a reason that the hub is attractive. Also, I want to point out that it is a promising ETF hub for certain ETF developments. Now, I was mentioning certain reasons why it may be attractive to trade Singapore listed, or why it may be attractive to trade ETFs listed in Singapore rather than ETFs listed in the United States. One of the main reasons we're looking at here are withholding taxes. So one of the largest ETFs for tracking Singapore equities, believe it or not, the ones in Singapore trying to compete with it, goes by ticker EWS, and it's listed in the United States. So it's a US domiciled fund that holds Singapore stocks. It's fairly large. It has hundreds of millions of dollars in assets. It's fairly liquid. It's been around since 1996. And in fact, many Singaporeans even trade this because it's so liquid. Perhaps also because it trades in US time when they're not at work. But the biggest reason why not to trade it is because if you are not a US person, and if you live in a place like Hong Kong or Singapore or Panama that does not have a tax treaty with the US withholds 30% of any dividend coming out of any US entity. Now, even though it's a US fund that holds Singapore stocks, it is considered a US fund. And so the US will hold 30% of that dividend. And you have to think of how silly that sounds. If you want to invest in Singapore stocks or Singapore real estate investment trusts, which right now have a 6% dividend yield, why on earth would you want that dividend sent all the way to the US and then have the US take 30% of it before sending it right back to you? That makes absolutely no sense at all. Now, if you are just based in Singapore, of course, there would be no dividend withholding tax. 100% of that dividend would stay with you. Or if you were in another location where Singapore does not apply withholding tax, you are still much more likely to get more of your dividend than if you send it to the US and back. So the general principle here is, when possible, try to avoid sending payments or having payments sent back and forth across borders multiple times. Try and look inside your ETF, see where that cash flow is coming from, and try and see how you can get the most direct route from your investment into your account. That's withholding taxes 101. Try to keep it as local as possible. Withholding taxes 102 is what I call the UCITS advantage. Now, there are going to be cases where you don't want to invest in Singapore, but let's say you want to invest in the US. Now, that's not really a type of ETF I'm going to be talking about here. I'm not going to say that you should consider trading the S&P 500 in Singapore, but if you did, there's a reason why, if you're not a US person, you would want to trade something called a UCITS fund, which is a European fund structure domiciled in Ireland. And because of Singapore's regulatory structure, they tend to passport a lot of these UCITS funds to list on the Singapore exchange. The thing to watch out for is if the ISIN code of the fund starts with IE, that indicates that it's an Irish domiciled fund, and if it starts with LU, it is a Luxembourg domiciled fund. Ireland and Luxembourg have tax treaties with the US where there is 0% withholding on interest and 15% withholding on dividends. And then coming out of Ireland or Luxembourg, there's no more withholding. So if you live in a place like Singapore or Hong Kong or Georgia or places that don't have treaties with the US, it is an attractive way to route those dividends to you. Another thing I also want to highlight is US estate and death taxes for individuals. If you are a non-US person and you hold more than $60,000 US of US situs assets, now that would include a US domiciled fund that holds Singaporean stocks, the amount over $60,000 US could be subject to US estate taxes upon your demise. So that's one thing that I would say, even if you hold the exact same S&P 500 tracker, but it's domiciled in Ireland, Ireland does not have an estate tax that they apply to foreigners. So even with the exact same exposure, you would solve potentially a big tax headache come the time to go through your will. So these are tax issues to be aware of, that even though the US is a very large and liquid ETF market, there are reasons why for certain markets and for certain investors, I try and avoid using US listed ETFs. So that's really the US versus everywhere else. Now let's talk specifically about Singapore and some of the ETFs listed there. So for comparison, I mentioned earlier that the US, and really here we're talking about the New York's exchanges. That's the NYSE, the NASDAQ, the Amex. Together they form the largest, most liquid ETF market in the world by far. Now, part of the reason for that is changes in how US financial advice has been provided. I operate along that model with my US company where I provide investment advice and managed accounts to my clients for a fee. I get no commissions for selling funds to my clients, which is why we want to use ETFs, which are a lot lower cost. That means the advisor can keep a lot more of the fee to themselves, but also provide full transparency to what their client owns. But also remember, when you trade US ETFs, that comes with all the US tax issues, and they trade during New York hours. For me, based here in Hong Kong, that means I need to wait until 9:30 p.m. my time before the market opens. And in the wintertime, I need to wait until 10:30 p.m. my time when we don't have daylight savings time. My option 2 is I can wait until 4 p.m. my time when the London market opens or the continental market opens. Notice that the London market and the continental market are more or less aligned. The London market opens at 8 a.m. London time, or it opens at 9 a.m. Frankfurt time to match each other. Now, in Europe, you can trade ETFs denominated in dollars, denominated in euros, denominated in sterling, in a bunch of currencies. They will be usually domiciled in Ireland or Luxembourg, though watch out, there are funds listed in London that are US domiciled. That's because the UK has a tax treaty with the US, even though the country you live in may not. And again, I'm speaking from Hong Kong, so that may not apply to everyone. The regime, as mentioned, is a UCITS regime. You also see something called a SICAV regime. Those are different kinds of European fund structures, and the main domiciles to look for, as mentioned, are Ireland and Luxembourg for their tax treatment. Now, the reason I mention Ireland and Luxembourg so much is that many funds listed in Singapore are also domiciled in Ireland and Luxembourg. The reason is if you've gone through the effort of setting up that fund, you can have a trade in Europe and you can have a trade in Singapore as well. Why not get the best of both worlds? And for those of us based out here, if we can trade them during Asian hours, we certainly will. Now, also on the Interactive Brokers platform, at Interactive Brokers, there are 4 exchanges out here in our time zone with significant ETF markets. The largest by far is Tokyo, is the Japanese exchanges traded in yen. The reason I don't spend quite as much time about Japan's ETF market despite its size is, one, it is very, very domestically oriented towards Japanese equities, and to some extent a few foreign markets that Japanese trade, but also because a very large percentage of the Japanese ETF market is owned by the BOJ, by the central bank, which overall, those 2 things make it far less interesting to me. Now, I am based in Hong Kong, and I am always comparing the Hong Kong Exchange and Singapore Exchange side by side. Now, overall, if I were to just summarize, the Hong Kong Exchange in general has a better selection of Greater China products, whereas the Singapore Exchange has a more diverse set of products overall, especially products having to do with real estate, Singapore dollar-denominated fixed income, Southeast Asia, and a few other markets that I'm going to mention later. There is also the ASX, which is closer to our time zone, traded in Australian dollars in Australia, that is also fairly domestically oriented to the Australian market. But for accounts that I manage that have Australian dollars in them, I do look at ASX-listed ETFs as well. So that's a brief overview of the world's major exchanges of ETFs that you're likely to look at when you trade ETFs in your Interactive Brokers account. Now, in terms of specific ETFs traded on the Singapore Exchange, I wanted to start with the list of fixed income ETFs. Now, I should mention that when you go to the Singapore Exchange website, you can go to the top of the website and you can see products, you can see screeners, you can see ETF screeners, stock screeners. And if you go here, you specifically will see a list of ETFs, and I've chosen to filter by fixed income. So I wanted to see what are the fixed income ETFs. They'll show me if I filter by that. And you will see here the ones with the largest turnover are A35, O9P, and MBH. So that's at the very top, and then the second and the third from the bottom. Those are basically Singapore dollar government bonds, and then towards the bottom, Singapore dollar investment grade bonds, and then US dollar high yield bonds. Those are 3 major categories, and I'm just going to break it down there rather than going to each individually. First, a little bit of disclosure. My firm, for clients, we do own shares of A35 and MBH, and I will explain a little bit about why in a moment. So first of all, for those of you who may not be familiar with the Singapore dollar, would wonder why on earth, if I'm not so interested in bonds, would I want to consider investing in Singaporean bonds of all things? One reason is just purely if you're developing a globally diversified currency portfolio, it is interesting looking at the Singapore dollar. So on this chart, I go all the way back to 1957, and I compare the Singapore dollar with the pound sterling and the Japanese yen. Now you'll see if you go all the way back to 1965 is when Singapore gained independence. Technically, it was independence from Malaya, and there was the separation of Malaya from the British Empire earlier. But consider 1965 the day of independence. And then you'll remember later in 1967, the British pound faced a major devaluation. And since then, the British pound has more or less continued a continuous path of devaluation from about $2.8 to the pound to right now around $1.25 to the pound. Swinging up and down over time, of course, but that's been the path of Singapore's former colonial power. On the other extreme, you have the Japanese yen, which right at the end of World War II was set at 360 yen to the dollar. And since 1971, when the currency started floating after the collapse of Bretton Woods, the Japanese yen has more or less appreciated, obviously with lots of swings along the way. If I were to just briefly summarize the job of the Singapore dollar, what the Monetary Authority of Singapore does when they manage the Singapore dollar, they are basically trying to manage it to a basket of all of Singapore's trading partners, with the goal of making the Singapore dollar fluctuate as little as possible against that average basket of currencies. So to the extent that Singapore trades with Japan, trades with China, trades with Germany, trades with Britain, trades with the US, Canada, Australia, the Monetary Authority of Singapore wants to make sure that the Singapore dollar fluctuates as little as possible against the average of those currencies. Now, the Monetary Authority of Singapore also uses the Singapore dollar as a monetary policy tool. So whenever there's a worry about the Singaporean economy overheating or a property bubble elevating, rather than raising or lowering interest rates, they will let the currency strengthen or weaken. And what you'll see that since 1965, the path has been towards general appreciation of the Singapore dollar. In the early 1980s, it was about 2.8 Singapore dollars to the US dollar. In the earlier part of the century, around 2000 around 1.8 Singapore dollars to the US dollar. And recently, it's been fluctuating between about 1.2 and 1.4. Now that it's at the low end of that range, kind of between 1.4 and 1.45, I very much believe that the Singapore dollar is one of the more attractive currencies to look at as an alternative away from the US dollar, especially when you consider the two major alternatives, the Japanese yen and the euro, both have negative bond yields, while the Singapore dollar at least has positive bond yields with that diversification benefit. So even though I know that was a mouthful, in a nutshell, I hope that at least gives you an idea of how the Singapore dollar works and why positive yielding Singapore dollar bonds should be attractive from a foreign investor who wants to diversify away from the dollar, from the US dollar. Now, I want to briefly summarize what is the difference between A35 and MBH. I mentioned earlier, my firm has bought both of these in the accounts of clients that have Singapore dollars. A35 is 88% government bonds, and most of the rest of it are agencies of the Singapore government. So examples of these would be Temasek and other agencies of the Singapore government. Basically, these are all AAA rated credits. So you're not buying A35 to take credit risk. You are really buying, in any other country, the equivalent of a US Treasury portfolio or a Bund portfolio. Since the Singapore government is AAA rated, most of the agencies are AAA rated. So that's what you're getting here. The duration of this portfolio is roughly 8 years, and when I took a snapshot of this on the 31st of March, the yield was 1.6%. So it's not a high yield, but at least it's a positive yield, which, again, I don't think should be overlooked if your goal is you want to have a globally diversified portfolio of bonds with positive yield to preserve purchasing power. Now, by contrast, MBH is supposed to be investment grade, mostly corporate bonds. There are still a 27% allocation to government bonds and a 27% allocation to banks, which I think is important. But there's still a significant allocation to non-bank financials here. Again, these are bonds that are denominated in Singapore dollars. And if you are familiar with the Singapore dollar bond market, Singapore government securities trade in $1,000 denominations. So it's not hard to trade individual Singapore government bonds if you want. But if you wanted to trade a Singapore dollar corporate bond, they trade in denominations of $250,000. So for access to this portion where you want to get a little bit more credit spread in Singapore dollars, but not traded in $250,000 cliffs, this ETF is one that we found quite attractive. So the average credit rating across the sector is single A. Compare that with investment grade bonds in the US, for example, where over 50% is triple B right now. The duration is slightly shorter and the yield is slightly higher, perhaps as should surprise no one. So roughly a 5-year duration and a 3% yield. Again, this was as of the end of March this year. Now, if we look at the charts, how did these two ETFs, these two specific types of bonds, perform in what I call the big stress test, the big shock that occurred in March when suddenly we realized that the coronavirus wasn't just going to be a Wuhan problem, maybe not just a mainland problem, but it was probably going to sweep around the world. It was probably going to be much bigger and cause big economic shutdowns. Well, what we saw at that time was we saw that the A35, mostly the Singapore government bonds, initially shot up in a flight to quality, quickly snapped back, but then since then, year to date, is up significantly. If you compare it to MBH, now I want you to notice the end of the year, that big jump down that you see in both of them is when the dividend was paid. So basically when the coupons of all the bonds were aggregated and sent out, that's not as though the market crashed at the end of the year. That's just when these two ETFs pay their dividends, pay out their cash flows. MBH did see a big gap down in March when pretty much every other investment grade bond market and investment grade bond ETF had its stress test as well. Now, it is mostly recovered, but unlike A35, it is not up on the year as much, or at least up to the end of last year, because again, you had that widening of credit spreads. When I talked about 3% versus 1.6%, that spread was narrower when I was looking at this late last year in October or November of last year. So that's why you get paid the higher yield. That's the risk that you're taking of spreads widening and a possible default or two, even among the single A's. So. I do get asked quite a bit about the high yield ETF, and one thing that I do find especially interesting is that Singapore has a high yield bond ETF listed. Hong Kong does not. And being that I live here, I'm very aware of the rivalries going between the two exchanges in the two cities all the time. But if you want to trade a high yield bond ETF in Asia, this is kind of what we got right now. And I will say, we do not hold any position in this ETF, and the main reason is just here when I look at the positions. The largest holdings by far are in mainland Chinese property developers, which are fairly highly leveraged, fairly cyclical companies. And overall, I believe that I do not believe their credit spreads warrant the credit risk that is in those companies. Now that said, they are very popularly traded bonds. Many private banks will finance and trade those bonds. So it is just really my personal and professional call of whether I think that is an attractive place to search for yield. Now, given that Asia has an aging population and interest rates are low, there is a very, very large demand for stable products that can provide good and steady forms of yield. So one hint to later on, my wish list of ETFs I'd love to see more of would be good higher yielding ETFs that aren't 57% Chinese property, mainland Chinese property developers. So here are the profiles here. You can go directly to iShares or to the fund provider and find what's inside. But this is just my opinion and my explanation of why we have not bought this particular ETF for our clients' portfolios. Now, talking about Singapore specifically, I mentioned the currency, I mentioned the bond market. I also want to talk a little bit about the equity market. And usually when I talk about Singapore's background, I start with this story from the Straits Times on August 10th, 1965, which, depending on your point of view, was the day that Singapore gained independence or the day that Singapore was kicked out of Malaysia. Really, whichever way you want to put it. But that's the starting point of that past since 1965. Now, I also highlight that in 1965, around that time, this was Lee Kuan Yew on the back of a little pickup truck going through typical neighborhoods in Singapore at that time. Now, I feel most people who think of Robinson Road these days and how modern a financial center Singapore is would be kind of amazed to think that within many of our lifetimes, Singapore really was an emerging market. And that's what gets to the title of his book, From Third World to First. That picture on the lower right-hand side is of Marina Bay. That really is the picture most of us have of Singapore today, a very modern, very advanced financial center, as I'll highlight in this next chart here. So economically, what makes Singapore so fascinating to me? Back in 1965, when Singapore gained independence, Singapore was poorer than average. So if you take the world average GDP per capita, Singapore was below average. And within the past 50 years, within the following 50 years, it surpassed the United Kingdom and it surpassed the United States. Now again, these are per capita numbers. It's GDP divided by population. A lot of that simply had to do with Singapore's location. It had to do with how much it benefited from trade with the rest of the region. But it also had to do with having excellent institutions, with having a AAA rated credit rating, with being a place that a Malaysian business and a Philippine business would want to meet in the middle and sign legal contracts because they trusted the rule of law in Singapore. So this chart, I believe, more or less speaks for itself, and I won't spend too much more time on it, but I feel very much worth repeating. Now, this was one chart that I entered just in the last minute, and I want to thank Cynthia for the getting the last minute approval to include this in the slide deck. But I do highly recommend to any one of you who have not seen this to go to YouTube and look up PM Lee Hsien Loong's speech. So his address really to the nation, where he started My Fellow Singaporeans. He was talking about what Singapore would look like and what to expect after COVID-19, basically after the market more or less seemed to have been contained, not the market, after the virus more or less seems to have been contained. And I have to admit the presentation was a little bit bittersweet because he was saying, do not expect things to get back to normal so quickly. Do not think that by the end of the year you'll be able to get on a budget flight to Bangkok or Hong Kong, that there will be jobs that will have disappeared forever. But the Singapore government is putting up about 20% of their GDP to try to get Singapore back on track, to try to make sure that there's proper training and reemployment and other things there. And I can tell you as somebody who has invested in Singapore quite actively for a while, I am very much watching out for how how I can benefit from how I can be a part of that recovery. So the reason I want to include this is I do highly recommend looking at that speech because I believe of any leader that I have seen throughout the COVID-19 pandemic, his addresses have been one of the best. So next, I want to go on to some Singapore-specific trackers. And the two here that will most stand out are really the ones that track the Straits Times Index. That is, if you get on the news and you look at how's the Singapore market doing, you'll see the Straits Times Index. Those two trackers are ES3 and G3B. And you'll notice that ES3 has about 4 times the trading volume. That's the older one by State Street Spiders. If you just ask someone, ETF, the first thing they'll mention is ES3. It's the SPY of Singapore, if you will. But of course, whenever you have an SPY, you get a close competitor to try to keep them honest, keep the liquidity in place. And I took this screenshot earlier on when these were still down over 20% for the year. But I also want to show the other Singapore trackers here include a REIT tracker. So that was the Lion Phillip S-REIT tracker. This is one of the real estate investment trust ETFs that specifically focus on Singapore ETFs, not the ETFs listed in Singapore that include real estate elsewhere, but we will see how special that is. Now, even though those two ETFs I mentioned earlier track the Straits Times Index, I have far more data on the MSCI Singapore Free Index. Now, if we put them side by side, the two indices are very, very similar. They pretty much have the exact same stocks in very, very similar weightings. So I don't feel too bad about showing you the weightings of MSCI Singapore, also known as SIMSCI, as a proxy for the Straits Times Index. Some of the main things I just want to highlight for any of you who may not know: about half of the index is banks, which was similar to what we saw with the A50. In fact, the top 3 are really what are called the banking troika of Singapore, the 3 largest banks, DBS, OCBC, and UOB. And then the next largest sector is real estate, specifically real estate investment trust. And you'll see as you go down, this includes names like Ascendus REIT and Suntec REIT. So one thing I often hear about the Singapore share market is it's not terribly diverse, and it doesn't have a lot of things kind of really beyond this. As I mentioned, these 30 stocks make up 85% of Singapore's total market cap. So even though there are a lot of attractive fundamentals in this market, it is not the largest market in the region quite yet, especially not when you compare it with a much larger market like we have here in Hong Kong. I also got this chart on the sector stability, the relative sector stability of the MSCI Singapore Index, and this goes back to 1999. Really what it's meant to show you is that, say, unlike the US index, where you used to see back in the mid-2000s, a very high proportion of the S&P 500 was banks and oil in 2005, and now it's very largely dominated by technology. For better or worse, the MSCI Singapore Index has had a much more stable balance of different sectors. And that has meant roughly a fairly constant 50% allocation to financials, 15% allocation to real estate, and a few other sectors that have kind of come and gone as well. You'll notice consumer staples has probably been a bit the most volatile, where it wasn't much in 1999, a little bit more than that now, but it really had a much larger part to play between 2008 and 2012. One of the parts there that I was a part of myself, I used to be a shareholder in SMRT and Uyan Sung. These are two names that you might be familiar with. SMRT runs the metro system, and Uyan Sung is an herbal medicine, ginseng, traditional Chinese medicine shop. Both of those were taken private over the past 10 years, which is a shame because those were two quality businesses that I liked investing in there. But that said, I made money from those privatizations, and those are the types of things I think we want to watch out for. If you would like a little bit more historical reading on the top 30 companies in Singapore, I highly recommend a book called The Singapore Blue Chips. One of the authors is my personal friend, Umesh Desai, and as a teaser at the very beginning of the book, he mentions that that Singapore-listed stocks can almost be thought of as falling into three different categories: MNCs, GLCs, and PLCs. MNC stands for multinational corporations, big companies that you probably know around the world. GLCs is government-linked companies. The fact is the Singapore government is very heavily involved in industry and does support business there, a lot like MIDI does in Japan. And then PLCs in this case stands for poor local companies. And that's the part that those who wanted to see more diversity in the small cap market are kind of mourning that you don't see more diversity there. But I think there is a virtual cycle when more foreign investors get in, prop up the mid cap and small caps with some volume, with some support, some more IPOs. I'm overall optimistic that we can probably see some more pickup there, especially with other rising economic activity in the Southeast Asia region. So also, if you go back to the website, the other thing I will comment SGX for is that they do have pretty good data on their website. If you go up to the stock screener, I put the address above, the www.sgx.com security stock screener, and you go to individual companies. You'll notice you can click through and get, for each individual company, lots of different information. So not just an overview, the valuations, financials, dividend, but what I also like to see is ownership. Because if I just wanted to screen, and yes, I am hinting at a wish list item right here, if you wanted to slice up the Singapore market and say, I really want to focus on companies that are majority owned by Temasek, or the ones that are not majority owned by Temasek, or the ones that have a majority inside shareholder, or the ones that don't, you've got all that information there, and it's not too hard to click through. I find that quite unlike, let's say, in other markets where I have to go to the financial statements and find this information on page 53. So overall, again, if you wanted to kind of drill down and poke what's inside my ETF, that's what you can get here on the Singapore side. One more quick chart as well on the fundamentals of MSCI Singapore. This chart was unfortunately only updated to mid-2018, but the PE ratios are again more or less the same. The point of this chart really is to show that the Singapore equity market and the Singapore REIT markets are actually still historically cheap by comparison. If you just look at PE ratio and PB ratio now versus in the past, I would be cautious about comparing them apples to apples versus other markets, again, because there's a very high allocation to REITs and to financials. And a low PE on a bank, it means very different things than a low PE on a tech company. If I were to compare by another metric, which is quite important to many of my clients who really care about income, so those who buy, for whom I manage portfolios where the real goal is to generate dividend income, dividend yield is important, especially when we look at dividend quality. Now, by this metric, if we look at all of the MSCI benchmarks across the Asia-Pacific region, and you'll notice here I'm including Australia and Pakistan and UAE and Philippines, Singapore does have the highest dividend yield over the trailing 12-month period. When I took the snapshot, that was only a few weeks ago on the 22nd of May. Now, I do want to temper some of the other metrics here. I'll put these here for your review if you want to take a look at it. But if you purely look at dividend yield and you've done those checks on what I've just showed you on those each individual names, and you don't believe it's if you believe it's a high quality enough dividend, sometimes this market may be attractive just for the yield alone. Now, again, I've done this because I have the data on MSCI indices. The ETF that we're going to be trading in Singapore is going to be the Straits Times ETF. Again, full disclosure, I do not trade ES3 because I have easy enough access to the individual names inside, and those are the names that I buy inside of accounts for which I have Singapore dollars. On to the specific topic of real estate investment trust. I mentioned earlier that Singapore is one of Asia's largest REIT and property trust markets. And this is a reputation they've been trying to develop for a while. As of this screenshot, which I believe was taken earlier this year, so it was 30th of April 2020, there were 44 real estate investment trusts listed in Singapore. Here in Hong Kong, we still only have 9. And the real estate investment trusts in Singapore cover many, many different markets. So, for example, there is a REIT listed in Singapore that owns property in India. And if you like real estate, I very often say you should like real estate investment trusts because it lets you save $500 a month, $1,000 a month into real estate, which is already professionally managed. It's not just going to be one small flat that you have to take care of yourself. It could be an office, it could be a hospital, it could be a shopping mall. And I'm going to go through some of those sectors later. But overall, for investors who like real estate, you can build a pretty good real estate portfolio. And if it's going to be global, it's going to include real estate investment trust listed on the Singapore Exchange. That way, I would say it competes really with Tokyo and with Sydney as REITs in the area, as a REIT hub in the area, and really is more diverse than either, given that it includes properties in these other markets. If you want to look at the total return of the S-REIT index, of the Singapore REIT index, going back to 2012, I usually recommend looking at the total return index. The total return index means you take every dividend and you reinvest it in the price at the time. That really shows what the total return you would have received over a period of time. Now you'll notice this includes that crash back in March, but overall it should give you an idea of what total returns to expect over a period of time if you had invested in the S-REIT market. This breaks it down by individual names. Again, I don't think there's too much for me to say going down each individual one, but it shows you that if you have Parkway Life REIT, for example, which owns hospitals. They also own, for example, Glen Eagle Hospital on the south side of Hong Kong, next to Ocean Park. That was one of the best performing REITs, quite understandably, because hospitals have not been a bad type of real estate to own. On the other hand, malls in Indonesia were the worst performing individual REIT of this sector. Again, this is trailing 10-year annualized total returns, so take that with the caveat that past performance is no indication of future results. If we break it down by sector, this one shows you dividend yields of different sectors of real estate investment trust, depending on what they do. So as I mentioned earlier, if you buy a real estate investment trust, that real estate investment trust may own residential property, it may own an office building or multiple office buildings, and it probably won't surprise most of you that as of April of this year, the real estate investment trust that owned hotels, that's the top line, hospitality, had a very, very high dividend yield, especially looking at the past year's dividend. If you are brave enough to go buy hotels right now, you could probably get a really, really good deal. Now, the real question there is if some of them cut their dividend or if they need to renegotiate, if some of them go bankrupt, that's obviously why you're getting paid an 8.4% yield. But as you go through some of these different sectors, you will see that different sectors have different dividend yields, and overall, it's not a bad sector when you compare it with real estate investment trusts listed in the U.S. So overall, if you're interested in real estate and you haven't looked at Singapore-listed real estate investment trusts, I've spent quite a bit of time looking through it, and I'd be happy to discuss with you some of the stuff that I found. If you wanted to use the stock screener specifically to filter for real estate investment trusts or other stocks in the real estate sector, now this filter will include the real estate sector, will include construction companies, for example. You can just simply go and you can filter real estate. I've also added one extra filter, and that I only want to look at these companies that have a dividend yield of at least 1%. When I apply these filters, there's 74 companies that come up. You'll notice that the top two are actually denominated in foreign currency. One is denominated in yen, the other one is denominated in US dollars. But then the rest of them include real estate investment trusts you might know: Maple Tree Commercial Trust, Capital Land Commercial Trust, Keppel DC REIT, and so forth like that. This is how you can go in, and as I mentioned, you can click through and get all the financial information on each of these individual names. Now, I want to move on to India. So we spent quite a bit of time on Singapore specifically, and as I hinted at earlier, next week, next Thursday on June 18th, I'm going to be doing a separate Singapore Exchange and Interactive Broker sponsored webinar specifically on investing in India, talking about the Indian economy, Indian rupee currency market, and other investment opportunities there. But one thing I wanted to highlight is that the ETF that tracks India is, perhaps not surprisingly, one of the more liquid and more well-traded here for quite some time. And the simple reason is that India is still a fairly tricky market to access. As you probably know, if you are an Indian resident, you can trade Indian stocks in your Interactive Brokers account. But if you're a non-Indian resident, you can't trade Indian stocks in your Interactive Brokers account. You can trade Shanghai and Shenzhen listed stocks through Stock Connect. You can trade Japanese stocks and stocks in many other markets, but not India. So if you want to access India, you can use futures, as I've discussed in other webinars, or you can use an ETF that will track India. And if you're a non-US person, there's a reason why you will want to use one of these offshore India-listed ETFs like the one listed here. The two here, you'll notice, they're ones that are traded in Singapore dollars and US dollars. And this is the part where I want to highlight the difference between an EIP and SIP. Don't ask me what those stand for. The real difference is about level of complexity. This is a rating that the exchange provides to say, is the ETF a simple one that holds shares, or does it hold swaps or other derivatives or other things that may make you want to look under the hood and be a little bit more careful here. As I understand it, some brokerage firms may require extra checks if you want to trade a SIP rather than an EIP, but that's the main thing to watch here. Point is if you want to trade India, take a look at this ETF and see if it's one that's competitive with other ones that you've looked at for your India allocations. The thing that I want to compare more broadly is one specific ETF provider. Now, I mentioned earlier the top one was a State Street Spiders one tracking the Straits Times Index. But one provider that's provided a fairly nice comprehensive suite of ETFs is DWS. This is Deutsche Bank's former ETF brand, and their brand is called X-Trackers, and they provide trackers for many specific markets. And you will see here, this includes the CSI 300 Mainland China A-Share Index, MSCI Thailand, MSCI Indonesia, MSCI Singapore, Brazil, Vietnam, Pacific ex-Japan, Asia ex-Japan, MSCI China Free, which includes Alibaba and JD and other names like that, an inverse one, which lets you short the S&P 500, MSCI India, and the ASX 200 tracking Australia. So more or less, if you wanted to build a diversified portfolio of Singapore-listed ETFs, you could do it with these X-Trackers and do specific country picking. Now, do note that all of these, except for the MSCI China one, trade in US dollars. So this is really meant more for an international, non-Singapore dollar-based portfolio. And the expense ratios might be considered relatively high. But remember, these are single country trackers. And single country trackers are still have higher expense ratios on average than, say, broad total market or broad emerging market ETFs. That said, if you want to use these to have tactical positions in individual countries, these would be worth looking at. I've sorted these by that specific day's turnover. That was on May 22nd. Shows you which were more traded and which were less traded on that specific day. So if we want to compare ETFs and futures contracts, what are the advantages of one versus another? ETFs are I generally consider them a buy and hold instrument. There are people who trade them short term, but the reason I use ETFs is in accounts that are saving a few $1,000s a month, and they just want to buy and invest regularly and hold those for many, many years at low cost. They're a low-cost alternative to more expensive mutual funds, and usually we're talking about amounts that are small enough that it's hard to build a proper portfolio with individual securities. As I mentioned earlier with REITs, if I'm going to be building a $500,000 portfolio of Singapore-listed REITs, I'll take the individual REITs and put the dividends on my schedule. If I'm doing it for $5,000, we'll just buy the ETF and call it a day. But the point is, when I use ETFs, I am accumulating them. I'm buying some every month to hold for a long period of time. If you want to short an ETF, it's like shorting a stock. You have to borrow it and sell it short. So there's a stock loan. You'll notice cash collateral in your account, and that's, that could be a good or a bad, really depending on what kind of margin rate and borrow rate you get. But that's something to keep in mind compared with a futures contract. If you want to lever up an ETF position, you're going to pay margin financing rate. Now, the nice thing about Interactive Brokers, they have relatively good margin rates for any kind of financing you get for an individual investor. But you would compare that side by side with a futures contract if that's what you're after. Generally, if you buy, let's say, an India ETF or a China ETF, it's going to come with the full currency exposure of that market. You're going to trade something in US dollars, and the shares inside are going to be denominated in local currency. And if that currency goes down, regardless of the shares, you're going to be exposed to that because you're buying something with cash, something physical in that way. And as I mentioned earlier, the lot sizes can be relatively small. You can sometimes even trade hundreds of dollars at a time, but easily thousands of dollars. You don't have to trade large amounts when you trade ETFs. Now, by contrast, every single one of these points I've listed for futures contracts you cannot buy and hold them. You're generally going to have to roll them, sometimes on a monthly basis, but at least on a quarterly basis. If I buy the June contract, I'll then need to roll it into September, then need to roll it into December, and so forth. Now, that can be a good or a bad thing if you want to make sure that it stays refreshed, but futures are not appropriate for just buying something you're going to hold for several years. Now, one advantage is if you want to sell short, it is just as easy to go short as it is to go long. You just simply sell instead of buy, and you don't have to worry about borrow. You don't have to worry about any of the other challenges with selling short. The financing is built in. So if you put up the margin, you don't have to worry about borrowing. You don't have to worry about what rate you're going to get. The financing is built into the price of the futures contract. So if you're trading large amounts, it's generally more cost effective to use a futures contract if you have a benchmark track 5 futures. Another thing which you will see, you saw last time when I talked about the A50, and then next week when I talk about the Nifty 50 in India, is that many of the futures contracts are what are called quanto US dollar. So for example, when I trade Nifty, I am trading in US dollars an index that's nominated in Indian rupees. So if the index doesn't move and the currency moves, the futures contract is not going to move, but the ETF is going to move. And the reason is because the futures contract is simply referencing an index and saying, okay, index went up 100 points, I'll pay you $100. Whereas the ETFs, you're actually holding something that if denominated in rupees will have gone up and down with the currency. And in general, not always, but in general, the lot sizes of futures contracts tends to be larger. You're often talking about tens of thousands of dollars, sometimes even hundreds of thousands of dollars for a single futures contract in notional size. Now, what is my wish list? What are some gaps and opportunities of what we're looking at here? One thing that I mentioned earlier was fixed income, specifically high yield, but I would also mention active. One of the biggest misconceptions I keep hearing when people think ETF is people think passive. People think index. But I want to point out that some of the largest fixed income ETFs in the US are actively managed. There's nothing saying that an ETF cannot be actively managed. And last time I looked at the process of listing an ETF on the Singapore Exchange, they seemed quite open to the idea of custom baskets, active management, and the other types of things that take to have a good active portfolio. This is especially attractive if you want to add a different high yield portfolio, one that's not heavyweight on Chinese property developers. If you want to add distressed bonds, if you want to do more renminbi or other Asian local currency markets. And another one which I'm really surprised the US beat Singapore to the punch on, was Sukuk. These are basically Islamic Sharia compliant bonds. The first Sukuk ETF was launched in the US earlier this year. And I'm kind of surprised, given that the Muslim population in the US is relatively small, and most of the buyers for that would be outside the US and wouldn't want to pay the withholding tax on the US ETF. So if any of you are Sukuk fund managers and listening to that, there's a clear opportunity I'm seeing here. I also want to highlight alternatives. So right now, the largest, quote, alternative ETF listed on the Singapore Exchange is one that holds gold. Perhaps not surprisingly, it's simple, easy to understand, people can trade it. It's an alternative to owning physical gold. And then the one other one I want to mention is equity, but perhaps more specifically, one's providing access to different markets or perhaps smarter beta. Now, SGX, as I've hopefully made clear, is already a bit of a lead in REITs and real estate investment trusts in accessing ASEAN, namely Thailand, Indonesia, Philippines, some of the other markets in this region. And also, as we'll mention next week, India. But really right now, we're just talking about plain old passive MSCI India. If I wanted to do India high yield or India quality or India small caps, as an international hub, until I can start trading these directly in India or in other markets here, these, I believe, are the exchanges available in our Interactive Brokers accounts that we're going to be looking at for these. So here's the final slide here. I want to thank you for your attention so far, and I wanted to put up my contact information, my WeChat QR code. I am also on Seeking Alpha, which I have found some attendees here earlier have found it useful to find my profile on Seeking Alpha or Twitter to see my specific viewpoints on some of these topics that I talk about. So at this point, I want to go down and see if I can see any questions here. So Cynthia, will I be able to see the questions? Because when I go to the questions section, I see the audio YY, but I haven't been able to type in anything. I'm not sure if there's, okay, yeah, I'm starting to get a question here. Okay, so the first question is, do I manage managed accounts? Short answer, yes. The two Interactive Brokers advisor account entities I listed earlier, that is one of my main businesses, is managing investment accounts on the Interactive Brokers platform. Some clients have me manage their whole accounts. Some clients have me manage a partition, usually for a specific objective, whether it's to generate income or whether it's to provide more targeted access to the China A share market or to the Singapore REIT market or so forth. But I hope that was clear. Yes, I manage accounts on the Interactive Brokers platform. Follow-up question. If yes, then how does it work? There is a link to it on my website. So there are steps where when you log into a portal, you can log in and you can appoint an advisor. You can either go to the marketplace or you can find an advisor. You would put in my firm's name and you would put in my firm's advisor account number. That's the account number that starts with an F for financial advisor. And you can either appoint my firm to manage a partition of your account or your whole account. If you'd like to contact me after this event, you can send me a direct email or direct message, and I can send you that set of instructions, the detail of how that works. But thank you for asking, because yes, that's one main thing I do. As much as I like talking about this, my main focus here is really, of course, making sure that I make it happen. So thank you for that initial question. Anyone else online? I will be staying here for a few more minutes to answer any more questions you may have about what we've presented today.
Well, while we are waiting for any additional questions, first of all, thank you very much, Tariq. Terrific presentation. I also want to point out, notice in the control panel on the right-hand side of the screen, if you would like to get a copy of today's presentation, it's available in PDF under the Handouts pane. Simply double-click that title bar and you can download the presentation from here. Also, I do want to remind you that we have been recording today's session, and each of you will get a direct link to today's recorded playback soon after the session ends. So if you do want to come back and review any of the concepts that Tariq has gone through today, simply watch your inbox later on this evening for a direct link to today's recorded playback and to the same webinar notes that we've been using for today's presentation. Well, Tariq, it looks like there are no additional questions, so we are going to conclude our event here today. Special thanks to the Singapore Exchange for making today's presentation possible, and also a great deal of thanks for Tariq Dennison and his terrific presentations. As a quick reminder, Tariq is going to be we do have him scheduled for discussion on India, trading India, coming up next week on June 18th. Information is available on the Interactive Brokers website. Underneath the education menu, there's a link to our webinars, our upcoming webinars, where you can register. If you aren't able to attend live, simply register and you'll also get a direct link to the recorded playback. So with that, we will conclude today's event. Right on time, Tariq, an hour exactly. So thank you very much. Excellent. Everyone, you can exit using the X in the upper right-hand corner of your screen. Have a great rest of your day, all, and thanks so much for your participation. Have a good one.